So any questions at this stage? We will take a quick break. The question answers can go on, and then we will come back and look at put options. But if anyone has any questions regarding the various levels, various categories, any clarifications, please feel free to let us know, or anything that we have covered so far.
Hey, Rupap, Cecilia here again.
Yes,
I don't have questions on the subscription. I'm already subscribed, but I do have a question regarding the intrinsic value.
Yes.
So basically, it's the value that we get out of the option. When we calculate intrinsic value, or when we talk about it, do we consider the premium that we pay?
Yeah, Cecilia, so the premium of an option that you need to pay should always be more than the intrinsic value. Okay, think about it. Otherwise, there would be a lot of demand for that option, right? If the premium that you're getting effectively, if the intrinsic value of an option is $1 and the premium is 90 cents, then that's an arbitrage, right? So a lot of people would want to buy that option for 90 cents, and that is what will push the premium up. So the option premium that you see in the market, which actually is the next section after the Q&A, we'll cover that. It comprises of an intrinsic value and an extrinsic value. So yeah, to answer your question, the option premium always is more than the intrinsic value. Now, having said that, you saw in the Facebook example, because of the bid-ask spread being the way they were, the bid price did not cover the full intrinsic value, right? And that's the reason I say that, it doesn't make sense to sell it at bid price. You will just go ahead and exercise the option and realize your full intrinsic
value. Yeah, Rupam, Paul here.
Yes, Paul.
Yeah, I have a question. Yeah, so I signed up in May, one of the earlier batches. I remember mine was for 1 year subscription. So I noticed this new packages are for lifetime. So if I were to sign up for the lifetime subscriptions, will my initial $299 USD be net off from this?
Paul, yes, absolutely. In fact, what Paul mentioned is Paul has been an existing subscriber of our Investing Fundamentals program, which we launched in January. And for all our, we always, for us, our existing subscribers are always priority for us. So once you're through the door, you will always be priority. So, so Paul just told you the figure. So when we first launched our options program for all our existing subscribers, we wanted to do something absolutely ridiculously crazy. And we wanted them to join the options program. So our launch price was just $299, but that time it was an yearly membership. So yeah, Paul, to answer your question, yes, absolutely. In fact, many of the subscribers, many of the people who are on this tutorial, they have already upgraded. That option is always there. So if you're interested, Fan Liang can just send you there will be a special link for you. You don't use any of these links. So there will be a special link which will just capture the difference, which you can use to upgrade. In fact, I was going to post in our course group encouraging all the annual subscribers to upgrade, because as you can see that all you guys, by the way, all our existing subscribers, you all have access to the diamond level. So you have already, because at that point of time we did not have the silver or the gold level, we talked about it. So you guys don't worry about you know, the access. You have full access. Just that the people who are the annual subscribers, I hope, you know, we have been able to offer you a lot of value, which you know, many of you who came and upgraded to the lifetime subscribers, you know, that tells us that they're receiving value. So we can provide a link which just captures the difference, and you can just upgrade to the lifetime.
Okay, thanks, Ropam.
Keith, the answer to your question is, if you're subscribed to the lifetime, which is what we talked about today, then it is for life. So it doesn't end. Oh, there are some schools that actually shut down. Yeah, yeah, there are some which do, but let me tell you the difference between us and many of the other schools. And it's actually a very, very good question. I'm very happy that you asked this question. I'm actually going to answer it now, and I'm going to include it in our FAQ. Okay, now there are two things that can happen. Actually, three things that can happen for which we can shut down. One is if, you know, either Fan Liang or I, we go under the proverbial bus. Now, Fan Liang right now has, he's kind of a prisoner in that room that you can see. And so he has no way of getting under the proverbial bus. And I'm extremely careful. I'm extremely risk averse. And it might be relevant to mention here some of the risk management practices that I practice in my own personal life. Do you know, my elder son is 17 years old, and we used to earlier live in Europe, a tiny country called Gibraltar. In fact, I moved to Singapore 11 years back. I'm a permanent resident now. And for the last 15 years, my wife and I, we have never been in the same flight. We always take different flights. I mean, when we are going on family holidays, it becomes very messy, you know, the logistics. Like I showed you, right, when we were traveling to South America, managing the international flights and then the local flights, where I travel with one son, my wife travels with my younger son, but we still do it. And that's, you know, our way of risk management. And we have reasons, because, you know, we do not have the kind of family support. My parents are no more, you know, we do not have the kind of family support. So our thinking was, when our kids was younger, you know, if something is to happen to both of us, and for some reason if one of the kids survive, then you know, there will be a problem. So the reason I'm mentioning this, my personal story, is because it is very aligned with the philosophy with which we also look at options. So even that question which I started with, what if I'm wrong, or what can possibly go wrong? That is, I ask this question all the time, be it in running our business, be it in our options program, or even be it in our own life. You know, later I'll tell you another interesting story where, just because I ask this question, how I often end up landing, you know, it's like a landing on my feet like a cat, you know, falling from a high floor. So yeah, so I try to reduce the risk on which I have control. And what is it that I can control? I can, you know, lead a healthy life. I don't smoke. I occasionally have a glass of wine here and there, but I am reasonably healthy. I swim every day, or at least 4-5 days a week. So of course, can something happen which is beyond my control? Like, can I get hit by lightning? I can. So what is not in my control is not in my control, but at least I try to manage what is in my control. So that risk is reduced. The second reason why we can shut down is, maybe Fan Liang is my partner and we can break up. Now, we have an excellent working relationship. We keep debating. It's not that we agree on everything, but I think we have an excellent chemistry. We have been masterminding together even before we, started MoneyWise Smart. MoneyWise Smart was actually, it started quite a few years back. It started as a blog, and then we co-founded the company as a business, and so far I absolutely enjoy working with him. I'm not sure whether the feeling is mutual, but we respect
Likewise.
each other. And I think it's a great thing. We complement each other. There are certain things which Fan Liang absolutely loves to do, and I absolutely hate doing those things. I will not tell him what those things are, so that so that risk, I think, is significantly reduced. Now comes the risk which many startups have, which is after some time they run out of money and they go out of business. Now in our case, that risk is absolutely zero, because by the very nature of what we do, we would be doing exactly the same thing even if we did not have a single customer. Fan Liang and I, we were spending our time researching companies anyway. We were doing, interesting option positions on our businesses anyway. And, frankly, I'm not in that stage of life where we are a struggling startup where, we have a short rope. I mean, and this is something which I mentioned to Fan Liang, that if we do not generate $1 of revenue ever from today onwards, our business will still go on exactly the way it is going on. Our existing customers will still get exact same support that they are going on, because we do not have any costs. We do not have any expensive offices. We do not have expensive employees. So we run everything on a shoestring budget. We are extremely profitable as a business, and that is the reason why we can afford to price our products at the level at which we have. And trust me, I mean, I'm not a fool. I have personally attended each and every option program which is available in the market here and also online. Guys, I'm not bragging. There is just no comparison. In fact, I don't know. I haven't seen all the names here, but some of the trainers of other programs are part of our community. They have enrolled for our program, and that that tells you something. So yeah, that was a long answer to a short question, that we are not going to shut down, because this is something which we would do anyway. Keith, I hope that answers your question. Any other questions that we have? Salim, yeah, I know that. The thing is, Philtown, he has been doing it for quite some time, and I know that they don't cover, because I have talked to multiple people who are subscribers of their program, and we are very conscious about the fact. And one thing, we always assure that whatever it is not about the price. For us, having the quality is important, because see, we don't think short term, just like our investments. Even for our business, we think long term. We are, I see a lot of these trainers who are also hustlers. They're, doing a lot of marketing activities, lot of stuff that we don't do that, because our time goes in research. We are absolutely happy to grow our user base at a very slow pace. In fact, you know what? We do not want a sudden influx of a lot of new subscribers, because we are also conscious about the quality of the subscribers. And I have been communicating with some of the subscribers, because we are not a trading service. We are not one of those Telegram groups who will give a option trade signal every week. We are not like that. You know, we believe in deep research. We go into the deep end and we think very long term. So what we would like to see happen is that the subscribers who are there with us today, even 10 years from now, I would like to see the same names. And you know what gives me immense pleasure? Just today on this tutorial, 2 of our subscribers, they have their father son duos. I mean, that is, I know of. There might be others. Vaibhav and his son, they are both here. Parag, who has been asking questions, his son Atharva, he is here. I mean, he is in university in the US right now, is back in Singapore. And that is what gives us immense satisfaction, that, that if our community members really think that we are offering genuine value, and when their children grow up, they would like to refer us to their children. By the way, there is another one. I mean, I don't know if he's attending today. My business school batchmate, the other day I got to know that one of our subscribers is actually his son. I couldn't make out from the name, and he's based in Norway right now. I mean, this is something that gives me absolutely enough pleasure. So considering the quality that we offer, will our price increase? Absolutely, our prices will increase, but I don't see our prices going to this level that Salim you're talking about anytime soon, because I also want to maintain the value to price ratio of our philosophy of offering disproportionate amount of value. Okay. Salim, the classes are pre-recorded, the videos, and every month we keep adding new modules. But what you're listening to now is not pre-recorded. I hope you realize this is a live session. I'm talking, I'm reading your question and talking right now. And I think we offer a lot of value through these tutorials. As you can see, and by the way, it is not we don't take shortcuts. I'm in Singapore. It's 11:30. It's already 3.5 hours. The last tutorial went for 4.5 hours. My partner, in fact, I'm trying to see whether he's dozing off. I mean, it's 1:30 there, and this is our commitment. So at the end of the day, I think at the end of a few months, the total amount of live sessions will be more than the total amount of pre-recorded sessions, for the very simple reason that the tutorials. Yeah, I think, Fanlian, I think you can call it a day. I can take it if you.
Yeah,
if you
all good. Just.
Okay, all right. Okay, so, and of course, we are always there to answer the question. So what we will do is we will go back to the Okay, so we go into the put option. If no one has any other questions. Okay, so the put option is a right to sell 100 shares or any underlying security at a certain strike price on or before the expiry date of that option. Sorry for the typo. Now, if a stock price decreases, the value of the put is expected to go up, often very significantly. However, by expiry of the put, if the share price is above the put option strike price, then the put will expire worthless. Now, guys, let me give you an example. Now, think of an insurance. Let's say you have a boat, and you want to insure that boat. Now, when do you think the price of the insurance will be higher? When the weather is very calm and there are not too many storms and very bright sunny days, or during the season when there's a lot of storm, the sea is very rough. When do you think the price for the insurance will be higher? I'm sure you can imagine that it will be a lot higher when when there is a lot of turmoil in the weather, when the weather is very rough. So similarly, when during market corrections, like the recent March is a great example, when the markets had corrected quite severely and the price of the put options absolutely shot up during that time. So if you have a way, or I can show you, we'll keep that for the part 2 of this series, and I will show you comparative prices for exactly the same at the money option, the same price, everything is same, maybe 30 days to expiry, and during March you will see the prices had shot up 3x of what they were in January. Now, this does not mean that the intrinsic value of the options necessarily shot up. So this happens because of the extrinsic value. That's something else which I kept making reference to, and we will look into that. Now, I will give you a quick example. CCL, this cruise company. Let me actually stop share and show you a real example of an option of Carnival Cruises. Now, you guys can see my screen, right?
Oh, not yet.
Okay, screen is not shared. Sorry. Okay, so what I'm going to do is I'm going to pull out. You guys all know what happened to Carnival Cruises, right? Because of this COVID. Okay, so CCL is the ticker. So I'm going to go back to January, and let's see how it looked like in the beginning of the year. Everything was fine. The share price was 51. You can see here, 51. You guys can see my cursor and everything, right? And it's legible?
Yep.
Okay.
Yeah.
All right. So now, everything was fine. Cruise company cruising along well. Now in February, the first traces of the virus, I think middle of February, it started coming out. Okay. So around middle of February, let's look at the 2021 Jan options, Let me get some more strikes. So, the beauty of this software is I can go back, I can change the date, and I can see what happened during that time. Now, you see the share price had already come down by about 20% to 42, but still holding on there. Now, let's say if someone who had actually in February, you probably didn't even need a crystal ball. You know, if you just thought that, you know, if this virus becomes a pandemic, because now it has already come out of China and, you know, different countries are reporting cases. So airplanes, cruises, you know, these are the companies which can get hit badly. So if someone had the foresight, unfortunately, I was not smart enough, I did not, but let's say if someone did, and they decided to buy some put options. Now, let's buy the this Jan 2021 put expiring in 336 days. And what I will do is, I will buy this, this 4260. So 45 is an in the money option because it has some intrinsic value. So what I will do is, I will, I expect the share price to crash more. So I will go and buy, let's buy one contract. Price of the contract is $7.10. Now you can see that there is an intrinsic value of $2.40. So the balance is the extrinsic value. And it might be relevant here to mention that an extrinsic value is also called the time value, which is about what, $4.70. So why is the option premium higher than the intrinsic value? Because this option has 336 days left for expiry. So there is a possibility that this option might become even more valuable. That is, the intrinsic value might go up even more. And that's the reason the market is assigning some additional value to this particular option. Now, imagine in case of this particular option, this is actually, I mean, okay, it's at the money, but it does not have any intrinsic value. I'm talking about the 42.5. This option, it does not have any intrinsic value. The entire value is extrinsic value or the time value. That is because the market is putting this value with the expectation that by January, the share price might fall further. So there is a chance that this option might get in the money. Whereas if the expiry, let's actually look at a expiry of 7 days and let's see how much is the extrinsic value for the at the money option. So these options are expiring just in 7 days. And here, look, the extrinsic value is just $1, which means that this option has much lesser time, just 7 days, to get in the money. So that is the reason why the extrinsic value is a lot lower. Now, if we buy this option, let's say we buy one contract of this option. So this is how our payoff diagram will look like. One contract I bought for $5.70. The maximum risk is $5.70 multiplied by 100, so $570. The strike is 42.5. So my break even will be 42.5 minus $5.70 because the stock price has to fall so much by expiry. And the expiry line is the black line. I will soon explain what these three colored lines are. So the break even works out to 36.80, which means the stock price has to fall another $5.70 for it to get into this profit zone. Now, this black line is the payoff diagram as of January, which is the date of expiry. But as of today, it is the red line. And you can see for options, their payoff diagram, the pre-expiry payoff diagrams are actually curved lines. So the red line is the payoff diagram as of today. So today, if the share price goes down slightly to just $42, then the position will show a $9 profit. If the share price goes down to $40, the position will show $98 profit. As the option, as time passes and as this option moves closer to expiry, the red line moves to the blue line moves to the green line. So what is happening here is a decay of the time value. And we saw from the option chain that the time value is so high here, but when the option is closer to expiry, the time value decays. Both are for the same option. The time value keeps decaying as time passes. So this is what the payoff diagram looks like. Now let's see what happened middle of March when, you know, the sky fell. So we changed the date to, when should we take it? Let's take it to 27th of March. Boom. You see, the stock price has fallen. Let me change the scale so that we will be able to see better. Let me make it 0 to 55. Yeah, so now we see the entire picture. So you see the stock price was here. The stock price has now fallen, and see the put option has exploded in profit. This axis is the profit. So now the profit is, you see here, 2,280. So that is how a put option works. When the stock price drops, you know, the profit explodes. It's exactly opposite to a call option. So is this clear so far? Any questions about the basics? I mean, this is just the basics of the put option. Of course.
For a beginner, it's clear as mud, to be honest.
Okay. All right. Anyone else? Any question? And you know, subsequently, this particular option, we see that in March this has happened. Let's see where the share price is. The share price had crashed to 14.41. Now, if I take it to the latest, which is today, the share price is around there, 16.59. So the share price has slightly gone back up, and you see the profit has slightly.
Rupam, we can't see your screen.
Oh, I'm sorry. Guys, this is the only thing that I don't like about Zoom. You know, you have to keep sharing screen again and again across applications. So yeah, so again, let me just change the scale a bit. 50. So see, today this position is sitting on, you know, $2,000 of profit. Even the share price had moved back up a bit. This happened when? This happened somewhere in March. I think somewhere in April, May, June. Let me just check some of the other dates. What happened in June? Oops. Clicked at the wrong place. Sometime in between Carnival Cruises, the share price, yeah, the share price has been around that level. So, you know, the position is sitting at a profit. Now you know what will happen if, let's say, the stock price just stays here and it doesn't move. So today it is the red line, right? Where you have about $2,200 in profit. If the stock price doesn't move, then gradually this red line will keep moving towards the black line, and you know, and the expiry, if the stock price expires around this zone, that is 16 levels, then the profits will come down to around $2,000. So that is how basically a put option works. Now, when do you use put options? As I said, like if someone had the foresight, they would have bought put, but it's again very difficult. That would be a case of trying to time the market. But even when the market is going up, and let's say you have a stock portfolio, some people, buy put options, maybe spend a little bit. It's like an insurance that they are buying on their stock portfolio to protect the portfolio from dropping in value. Of course, I mean, I used to do a lot of that, and we will cover that in one of the modules that I talked about. Callers, I don't do it now because I think because I spend much more time in trying to understand the businesses. My insurance comes from the understanding of the business. However, if someone is worried about market volatility, having a put option along with a long stock can be a way to insure one's portfolio. So is that clear how a put option works? Everyone has fallen asleep, I think.
Nope.
Can I see some yes if it is clear, so that Vaibhav, obviously it will be clear to you. I want to, okay. CWD.
A little bit.
Okay,
Maybe it will take some more time. Since we are beginners, maybe it will take some more time.
Okay, not an issue. I mean, it just requires you to be familiar. But intuitively, you understand, right? That this is opposite to a call option. Yeah. So this increases in value when the underlying
Share
price goes down.
Yep.
Okay. Now, just like I showed you the payoff diagram of a call option, this is how the payoff diagram of a put option looks like. You can see the screen.
Yep, we're able to see.
Okay, so you see here for the CCL stock, again here it gets into a profit zone when the stock price falls. So the stock price goes down. Here the stock price is on the x-axis. And if the stock price goes up, then of course the option becomes a loss-making option, but your loss is capped because I have purchased the stock. I have purchased the option. So here, in this example, I purchased 10 contracts of January 2021 40 strike puts. So here my maximum risk is $4,400 because I paid $4.40 for this put. So $4.40 multiplied by 100 is 4,400. So that is the maximum loss. Whereas if the share price drops below 35.6, which is this break-even point, then we have explosive profit. And again, if I flip it just like I did, for the call option, where if I flip it, so you'll see the y-axis is the stock price and the x-axis is the profit. So as the stock price drops, the profits will increase. So this is how the payoff diagram of a put option looks like. And imagine if Carnival Cruises goes to zero, if the company goes bankrupt and it goes to zero, it's possible, right? Then this put option will have the maximum profit, which is what? Which is almost $35,000. So that is what will happen. And you can also calculate it from, you can also see the maximum profit is $35,600, which is basically $40,000, this 40 put, which means you have the right to sell the stock. Even if the stock price goes to zero, you have the right to sell the stock at 40. So your 10 contracts control 1,000 shares. So you will sell 1,000 shares at $40. You will bring in $40,000, but to enter the put option, you paid $4,400. So that's why your maximum profit will be $35,600, the remaining amount. So that is basically how the put option works. So yeah, I already mentioned put option can be used to hedge the decline in stock prices. This can be quite a useful strategy if used properly to protect a stock portfolio from the market price corrections. And here we talk about what we already alluded to, that the market price of an option should always be greater than or equal to the benefit the owner can get by exercising the option. And this benefit the owner can get by exercising the option, this is basically the intrinsic value. So the market price, here mind the word should. It should always be greater than or equal to. So if not, then it will be suboptimal for the owner to accept the market price, as we saw in the Facebook example previously. So we have already, talked about this. In this case, we are looking at a Facebook call option, which is in the money. Now we are back to a call option. And this particular call option has an intrinsic value of 130, 159. So $29.60, whereas you see the bid is $33.20. The ask is $36.20. So the excess over and above the intrinsic value, it is shown here. You see the extrinsic, this $3.60 and $6.60. So this $3.60 is the extrinsic value in the bid, and $6.60 is the extrinsic value in the ask. And the balance, $29.60, is the intrinsic value. So this is what it looks like. Option premium is made up of the intrinsic value and the time value, or the extrinsic value. And we have already seen this. The call option intrinsic value is equal to the share price minus the strike price of the call. And the put option intrinsic value is the strike price of the put minus the share price, because this is the right to sell. By the way, I mean, even if this, you are not being able to retain it at the top of the mind, once you watch the recording and look at an option chain by yourself, it will all fall in place. Trust me, these concepts, it took me like, I was never the sharpest pencil in the box. These concepts took me quite some time to fully internalize. When I started learning options, that is like many years back, it took me some time to fully internalize these, maybe several months. So absolutely progress at your own pace. Remember, guys, this is not a sprint, this is a marathon. So it just doesn't matter if someone else is racing ahead, as long as you are spending. And all it takes is just 15-20 minutes of practice every day, just 15-20 minutes of maybe half an hour of self-education. Everybody can take out that time. If you can show your commitment, and if you can progress slowly, even if it as a snail's pace, at a snail's pace, I promise you that, it might feel frustrating that, oh, my progress is so slow. But what happens is we often overestimate what can be achieved in a day or in a week or even in a month, but we grossly underestimate what we can achieve in a year. So if you can show the commitment of making slow progress, and the very fact that you have been in a tutorial for over 4 hours, that shows your commitment. All you have to do is just make steady progress. A year from now, 2 years from now, you will be in a completely different place. And that is how magic happens. So, if you think that the portfolio which I showed, if you think that happened overnight, well, that overnight success took me over 10 years to achieve. So the same happens with everything.
Hey, hi, Rupam.
Yes.
I have a question.
Please.
Now, when you say we buy a put,
yes,
somebody has sold a put.
That's right.
Right. So now when he has sold the put, he has sold his right.
Yes.
So
He
how
has,
does he cover his position? Because, there's nothing in his hand now,
okay. So,
nothing in his control.
so if you have purchased the put, sorry, why did I stop sharing? If you have purchased the put, you have purchased a right. The person who has sold you the put, that person has assumed an obligation. Again, the moment you have this confusion, think of the insurance company. When you buy your insurance from AXA or Chubb or whoever, you have the right to a claim, right? If something goes wrong with your car or your valuables. But the insurance company will be on a hook if something happens to your car, right? So similarly, the person who has sold you the put option is on the hook if the stock price goes down. Now, let me tell you my story. Now, I sell put options all the time. Okay. Now, if I just sell this put option without keeping the funds ready, and if Facebook for some reason goes to zero, then I will be on the hook for every contract that I have sold, I will be on the hook for $15,960. That is my risk, right? And if I don't have that money, then my position will get liquidated. I will owe that money to the broker. The broker will not, first of all, not let me sell the put without putting up a margin. Whereas when I'm selling a put, like I told you, Facebook, right? I actually have sold, a long-term Facebook put for 140 strike. Means that I'm happy to take that obligation of, if the share price goes down below 140, and if the option holder exercises the put, that means I will be forced to buy Facebook at 140. In my case, I will be delighted to do that because I will salivate to buy Facebook at 140 because I understand the business, I've studied the business, I feel that is a very good margin of safety. So I have kept my cash aside. So you understand. So if I did not keep the cash aside, then the put option will be called a naked put. That is, the seller would be selling it naked.
Yeah.
And the video which I showed you, that hedge fund manager who was crying, and that is what he did. He thought he was very smart. He thought he can navigate the market, but he has been selling naked puts without having the funds. So suddenly, when these futures, whatever oil or currency futures, whatever he sold, I don't remember, they went against him, by a larger amount than what he was prepared, he got completely wiped out. And that is exactly what happens to people who sell naked puts. But people like us who intentionally sell put options with the objective of acquiring the shares, we keep our funds ready. And for us, the premium that we bring in, that is a return on those funds that we have kept aside. Make sense?
Absolutely. So you write a put only when you have funds or you have shares with you, stocks with you.
No, I write when you say you, as in,
So an investor.
Rupam, no.
Yeah.
A lot of investors do naked puts. There is no law that stops them from doing naked puts. I'm saying that is a risky thing to do.
Yeah.
So I don't do it, but people do it.
So I'm saying typically puts are returned when you have either cash or you have that particular stock with you.
No, you don't need to have the stock. You don't need to have the stock. You are, you are writing a put. You are writing a put to be able to take the obligation to buy the stock. You don't need to have the stock with you. Okay. The broker will need you to have some funds available as margin.
Yeah.
to prevent that wipeout scenario, because
Yeah.
otherwise the broker will be on the hook, right? So that's why
Yeah.
they would need you to put up some margin. Clear?
Okay. Okay. Okay.
Okay. So in this case, you see in this, so in case of this particular Facebook call option, the intrinsic value is 29.6, and we saw this is the extrinsic value, which is listed here. So the extrinsic value of an option is the portion of the market price of the option that exceeds the intrinsic value. And this is also known as the time value. Higher the extrinsic value of the option, higher is the potential of the option to become more valuable by the time it reaches expiry. It's again, explaining in a very simple term. If you buy a travel insurance that is valid only for one trip, the insurance premium will be a lot lower, right? Whereas if you want to buy a travel insurance which is valid for one full year, then the insurance premium will be much higher. And this insurance premium is entirely the extrinsic value. The premium is higher because there is a higher chance that you will probably lose a bag or something will happen, or maybe the airline will damage some checked-in luggage during a one-year period. So to factor that, the extrinsic value is higher when the expiry date is far away. So yeah, we have seen that. Now, Fabian had started saying that OTM options. So options which do not have any intrinsic value, they are called out of the money options. So in case of call options, this stack, this is basically the out of the money options. Whereas these are the ITM, which is in the money options. Actually, this particular one is considered as the at the money, which is because 159.6 is the share price and 160, the one which is closest to the share price, is called the at the money option. Whereas in case of the puts, it flips. So these are the options which are out of the money. The share price is here. So if you buy a right to sell a stock at 130, that means that option does not have any intrinsic value. It's only extrinsic value. See, only extrinsic value, which is this. So this is out of the money. This one is ATM and this one is ITM. So that is how the puts look like. And this is the final picture of the evening with which we will end our part 1. Now, Vaibhav, are you there? Still?
Yeah, I'm there.
Oh, fantastic. Vaibhav, can you do me a favor and explain this while I take a water break? That will be a big favor. The time decay.
So basically what you're seeing here is how the time value, or which is also called the extrinsic value, which is the value of the option on and above the intrinsic value, how that changes with as you start getting closer to the expiry. So if you have, for example, two options, one is expiring on Friday, September 18th, and another same strike option expiring in October 16th, the next expiry, and suppose the same option expiring in January 21st in 2021. Which option will have a higher extrinsic value or higher time value? So naturally, the option which is expiring the furthest will have the more time value. And as you start getting closer to the expiry, or as you start moving closer to the expiry, the time value or the extrinsic value starts reducing, and this shape of the curve It's not like a straight line. It's typically a parabola, or it's more like a square root relationship between the number of days and how the extrinsic value changes. So just as a rule of thumb, the more further away the option is, the time value will be higher. And the closer to the expiry you start moving, the time value will start reducing. And at the expiry, naturally on the day of expiry, the time value will collapse to 0. Whatever is left of the option is the intrinsic value. So if the option is in the money, you will have the same value as the intrinsic value. If the option is out of the money, the option will expire worthless or at 0. So any questions or comments here?
Is that clear, guys? I think Vaibhav did a great job explaining.
Yep. So can that be understood as the premium would be higher for the farther options that are farther out?
Exactly. Absolutely.
Absolutely. See, because think of it intuitively, right? I mean, farther away you are in time, the more time you have for your objective to play out. Think of it like this, right? So obviously that'll cost you more. I mean, it's as simple as that. Yeah.
Risk is more, and
exactly. If I want to go and buy a car insurance, and if they quote me like whatever $200 for the car insurance for 1 year, and if I tell them that, look, I want to buy an insurance for 10 years, can I still have it for $200? They'll ask me to take a walk. They'll say that absolutely no. I mean, it will be much higher. So it's exactly same. Whereas the intrinsic value doesn't change. If, let's say, if I have purchased a 130 strike option, and if the share price is 150, 130 strike call option, and if the share price is 150, which means the option has $20 of intrinsic value. If, let's say, and this option is, let's say, a long-term 1-year option. If after 1 year, somehow the share price is still at 150, the intrinsic value is exactly the same. Whereas the time value initially would have been a lot higher, but by expiry, as you can see in this picture, the time value will collapse to 0. There is really no time value. So it is as good as, just buying the stock at 130 and I have the opportunity to sell it at 150 and make 20 bucks, or I just hold the stock, So that is what happens. And as Vaibhav explained, the shape of that curve, I mean, the drop is the steepest on the last day, in fact, typically even the last hour is when the drop is the steepest. Whereas if you buy options, so that's why I like buying options which are far out in expiry, because the time decay is very low, in the initial period. Look at this here. I mean, yeah, it's dropping, but it's very low. So if I have purchased an option, this, as the extrinsic value is going down, which means my option will lose value, right? Because of the time decay. But this loss is very low during the initial period. Whereas as we move forward, in the last 1 month, it starts accelerating. In the final day, it's boom, it loses all time value. So that's how time decay of an option works. Now, you can, even though I haven't told you, you can intuitively imagine that, okay, so time decay hurts the person who has bought the option, which means it must be benefiting the person who has sold the option, right? Imagine I sold the option, which is, which is out of the money, and I brought in some premium. As the time passes, And if the option stays out of the money, the premium goes to zero, and it will either expire worthless if it is still out of the money, or I have the option of, you know, buying it back at a much cheaper price as compared to what I sold. So this is like, let's say I purchased a insurance policy from AXA for, you know, whatever, $1,000 for 1 year, and just 1 week before the expiry, AXA comes and tells me that, hey, you know, we can offer you $200, but we will cancel the policy, you know, something like that. So they are effectively buying back the put option which they sold to me for $200. So which means they sold it for 1,000, bought it back for 200, something like that. So they made $800 spread in the process. Okay, so that's the last picture of not of options theory, but of today evening. We have a part 2, and you know what, guys? Now I'm thinking that it might spill over into a part 3, because there is so much to cover, and this is still basics. You know, this is still like bringing the newbies up the curve so that they can kind of hit the ground running. But we will do it. It's fine. Okay, so now there are quite a few questions. Let me quickly look at the questions here. Stop with the Jillian, does the time decay always accelerate, say, when we have 3 months, 90 days to expiry, or it depends on other factors as well? Jillian, it absolutely depends on other factors, you know, and that is where the implied volatility comes in. So we will cover that in part 2. So it is quite possible that suddenly, let's say the time value has been decaying slowly, but suddenly something happens 1 month from expiry, and again more time value gets injected into the option. So that can very well happen, you know, that can absolutely happen. In fact, typically just before earnings, you know, just before the companies announce earnings, something happens to the option prices that we will discuss in our part 2, which basically injects time value into the options. Yeah, Vaibhav is actually absolutely right. The time decay is a function of the square root of time, hence the parabolic shape. So closer to expiry, the rate of decay increases. That is like, you know, under normal circumstances, unless, you know, something suddenly happens and, you know, the time value.
Yeah, so Rupan, Julian here, can you hear me?
Yes.
So my question is, let's say if you buy, let's say a $200 call option, right?
Yes.
Let's say you still have a couple of months to date to expiry.
Yes.
But if the option is already dip in the money, let's say the share price has gone to 250 or something like that, then why wait to the end to close the call option or something like that? If your time decay will hurt you, shouldn't we close it slightly earlier before the expiry date?
You know, Jillian, it completely depends upon your objective. Like when I buy call options, I actually buy call options to be able to buy the stock. I mean, most of the time.
Okay.
If it's a you know, speculative position where I plan to close the option position, then that's different. Now, you mentioned in your question that the option is deep in the money. You know, later I will show you that the time value is actually the maximum when the option is at the money. Okay.
Okay.
So let's say you have bought an at the money option and the share price, you have bought a call option, the share price moved in your direction and the option is deep in the money now. Do you know, a deep in the money option, the time value actually is very less. So the time value reduces as you're moving closer to expiry. That is one. The time value also decreases as the option is moving away from at the money. Let me actually show this picture, then you will you'll understand. You still can see my screen, right?
Yes.
Okay. Now look at this time value is the extrinsic value, right? Both on the put side as well as on the call side, just look at the extrinsic value. Now, this is just one expiry, which is 79 days to expiry. So all these strikes are expiring on 19th of June. Look at the extrinsic value at the money, which is about 14, 15 levels. See, when you go in the money, the extrinsic value decreases to so low. And when you go out of the money, then also the extrinsic value decreases. Same thing happens with the put. So the time value is actually maximum at the money.
Okay.
It's clear, right?
Yeah.
Okay. I don't see any other questions in the chat. So if anyone else has any other question, please feel free to unmute and shoot.
Yeah, Rupam, this is Naren here. Do you have any suggestions on which software to pick to just start? I'm just a beginner.
Naren, if you're a beginner, you really don't need any software. Which broker do you use? Do you already have a brokerage account?
Yeah, I have an account with Charles Schwab in the US.
Okay. Where are you based? Are you based in the US?
Yeah.
Okay. See, I mean, I used to use Charles Schwab in Singapore, but they exited from Singapore. So I can't use it any longer. Now, I don't know in the US if you use the same platform, but Charles Schwab has enough material. I mean, you know, first of all, you can go to the option chain, you can look at the options, and Charles Schwab also has some free resources for you to learn about options. If I remember correctly, they have this this education, so you can go through them. They're actually quite good. So frankly speaking, you do not need any software. I mean, I use this software to analyze my option positions. You know, right now, I mean, when I subscribed, it used to be $15 a month. Right now, I think it's $25 a month. In fact, several of our community members have subscribed. It's excellent. It's really good. But you can, if you're, I'm telling this to you because you're an absolute beginner. If you're, you know, an intermediate or progress with options, then this software is amazing. But for an absolute beginner, you live a perfectly happy life even if you don't invest in any software.
What is the software?
This is a software called options analysis.
Options analysis. Okay.
Yeah, which is what I use to analyze all my positions, you know, go backdated and check. Plus, it helps me to look at the option Greeks when we cover the option Greeks, stuff like that.
Rupam, is the data in option analysis real time or
no?
Like
I think 15.
1 day lag.
No, 15 minutes or half an hour. I can't remember exactly. I can check with them. I think it's half an hour. Half an hour late. Half an hour.
Okay, thanks.
Yeah.
But Rupam, you use this platform only to analyze, whereas buying options, you use another platform, right?
The buying options, I use Interactive Broker. So what used to happen is, so earlier there used to be a different version of options analysis. I think these guys, they moved out and you know, created their own software. The look and feel is exactly the same. So the earlier version that was there, that used to be connected with I don't know if any of you remember this broker called Options Express, which got acquired by Charles Schwab. So I could analyze an option position, and there used to be a button. By clicking it, it would send the order straight to Options Express. It would use the same login. So that connection was there. But right now, frankly, it's not required because I'm not, you know, trading, right? For me, these are all long-term positions. So So I use interactive brokers to put in the orders.
Rupam, yeah, Paul here.
Yes.
So I have a question. When you buy out the money calls, what is your preferred exit strategy? Is it to hold it until expiration and to exercise it? Or let's say along the way, if the implied volatility increases and the call option price goes up, would you consider selling it at that point in time?
See, Paul, I personally, you can still see my screen. One second. Most of my call options, they're longer term, but I have done some shorter term positions. Like recently, I talked about this Berkshire Hathaway position that was extremely profitable. Then currently, I have a position on JD. I'm talking of the short term position. So recently, these are the only two short term call options that I have done. Now, this particular JD option, this particular JD option, I had 13th of August, which is exactly a month back I had done. So in this particular case, I mean, I'm just letting it run because I have already minimized the downside risk. But if the position has gone up in value significantly, I might decide to. There is no hard and fast rule that I follow. Typically, because my reasons for entering these positions are fundamental. Like even JD, I knew that this COVID time, when they announced the results, an e-commerce company, they're expected to announce good results. So that is the reason I purchased. So I just held on to it and just let it run. It will expire in another 3 days. So I'll just let it run till the end, because I realize that is where the explosive profits happen sometimes. Or I sometimes maybe take part of the position off the table, so make it risk free. So I do those things. No fixed rule. Really.
There's also any explosion in the implied volatility and the extrinsic value actually creates it's a good dilemma for you to
absolutely. And that is exactly what I did. If you see the position on the screen, this JD position, I mean, I had actually purchased some 66 contracts, and at that time, obviously, when I purchased, there was you can see that max risk, which all the other positions show. Here it is showing as min profit, which means the position does not have any risk anymore, because when the implied volatility had shot up, 33 out of those 66 contracts I sold at a profit, and because of that, my position became completely risk-free. And you see this payoff diagram moved in the profit zone. So there is nothing that is left in the loss-making zone. So that is what I had done. So absolutely, if suddenly, if it is a short-term call or a put, and if suddenly there is a jump in profit, I mean, I would make the position risk-free, at least by taking some off the table.
Okay, so the analogy is just like when you hold a stock and the stock runs out in price very quickly. I mean, you might consider selling it sooner than the expiration date. I mean, that's the kind of consideration.
I mean, in stock, I mean, a lot of people do. I personally don't. I personally just like to just sit on it long term, and that is something which I explained last time also. I mean, I'm a very lazy seller when it comes to stocks. But yeah, the equivalence is understood. Yeah, exactly like that. I mean,
Okay, I understand. Yeah.
if it has unrealized profit, then might as well reduce some risk and use the funds elsewhere. That is the thing. I mean, I would sell if I have better use of the funds. Definitely use the funds elsewhere. If something else is more attractive, it's that.
So there's no simple like the XIRR calculator that you use for puts. There's no equivalent calculator you have.
In
Yeah,
the
right.
calls, there is no. I mean, you can force fit a calculation like that. By the way, guys, for the newbies, I mean, what Paul is referring to is how we evaluate when we sell put options. We bring in the premium, so we use XIRR, which is basically the internal rate of return that we calculate on the cash flows to bring in. So we covered that in the option series program. So in case of calls, what happens is, Paul, you have to understand that there will be a if let's say you take this strategy that, okay, I will keep buying short-term calls. So what will happen is a large percentage of these calls will end up making a loss. That is, you'll end up making the maximum loss. But a small percentage of them will show that explosive profit. So whether the overall strategy is profitable or not, that you can't make out just from one trade. That you have to do at least 100 or something like that, something that is statistically significant. Only then you'll be able to make out. Now, the reason here the XIRR calculation is not valid, in case of the put, the upside is fixed, so the cash flow that you're bringing in is fixed. Whereas in the call, I mean, that one trade which I shared, that Berkshire Hathaway, one $10,000 investment, within a month, I closed the position at a profit of $123,000. So that will send all your XIRR calculation, out of the window. That's the reason why in calls it's difficult. You can only have an estimate of the returns you're getting after you have done like hundreds of trades and it establishes some kind of a pattern. That's the thing. So that's the reason I just keep my call options open to run.
Okay, so this is just one final question to between buying short dated calls and long dated calls, which is your preferred choice?
Oh, absolutely, long dated. I don't buy short dated calls at all. The two examples are exceptions, which I did for very specific reasons. Otherwise, if you guys can still see my screen, right? So all these positions that you're seeing, I mean, many of them, I mean, I have sold puts. So I'll give you, let me show you position in Microsoft. Okay. Let me know if you can see it. You can see it, right?
Yep.
Yeah, so this particular position is a combination. I have sold some puts and I have used some of the funds to buy some calls, and see when the expiry is. The expiry is 732 days from today. I have Facebook long dated calls. So these are like leap calls, which kind of are a proxy of owning the stock, because I did not want to like put up the money, so I'm using the long dated calls. However, look at the strike of the calls. So 165 strike calls. These are the ones which I bought. So I have 1, 2, and 3. 3 of these 165 calls. Now the share price is 205. So I'll just let it run. I have no requirement of messing around with this. After 732 days, if the share price is above 165, I will just purchase the stock. So I have done this not for any speculative reason. I have done this because I genuinely want to own Microsoft. And first of all, I sold 630 puts, you can see. And by selling the puts, I have taken on the obligation of buying Microsoft at 130. Now, if Microsoft comes down to 130, I will be delighted to fulfill my obligation by buying the puts. But what I did was I took part of the premium that I brought in and I went ahead and bought the calls. And in the process, I still brought in a credit. So if my puts don't get exercised, and if the stock price is above 165, I will end up buying Microsoft stock for 165. So my objective is that I really don't care. In fact, frankly speaking, I didn't even know before opening this what the current stock price was. I haven't even looked at the stock price of Microsoft for several weeks now. So now I'm noticing that it's 205, and I also am noticing that it had gone up to 230, which I didn't even know. So, it doesn't matter. The short-term thing doesn't matter. My objective is, I have looked at Microsoft. I will want to own, I like their cloud business. I want to own the business, and I think these prices provide me with a margin of safety. That's the reason I have bought this call. This is not a short-term speculation. Whereas this JD position, which I showed you, is actually a bit speculative because I expected, okay, not a technical analysis kind of speculative. It is because I expected JD to announce good earnings. And that is exactly what happened, and the stock price ran up. Is it possible that the earnings were not good and the stock price would have fallen? Absolutely, it would have been possible. This was, I took my chances because, considering COVID and considering, probability, I did that. But I could have very well been wrong in the short term. That's why my worst case scenario is capped. I won't have lost too much.
Okay. Yeah, I think I'll stick to the safer one, buying the longer dated calls.
Yeah, I would do that anytime. These are just two exceptions. And these short dated calls, I haven't done it for a very long time. Like these 2 months, 2 consecutive months, I have done these two. These are like, that's it. That doesn't mean it, it doesn't work for, a lot of people do it. It's just that I don't. That way there are like thousands of different ways of doing options, So I just stick to some basic stuff which works for me.
Okay, thanks, Rupam. Yeah, thanks for the answer.
Welcome. Anyone else? Guys, I think people have fallen asleep. How many people are still there? Wow, there are still 34 people awake. You guys. Wow, I'm amazed.
We are in the US, so
yeah.
we're still awake.
Yeah, you guys are in the US. But nevertheless, this is, this actually crossed the previous record. The last tutorial was 4 hours, 27 minutes, and this is already 4 hours, 39 minutes. So good. So I think we are on a record breaking. Okay, so any other questions, guys? Otherwise, anyway, we are not going anywhere. You can keep your questions ready. Send us the questions. We can take them up in the part 2 of this tutorial. We will, in the part 2, we will actually see some examples, and we will talk about selling calls and selling puts. So that's how we divided the two, and we'll take some real life examples. The whole idea was, so that you get the complete this thing. And today I did not have the time, or else I actually wanted to do. So in the part 2, I'll do it. I'll actually go to my, IB account and maybe show you an actual option order. I will place it and get it fulfilled and see how it goes.
Are you currently based out of Singapore or?
Yes, currently based out of Singapore. Can you cover option Greek? Consider when to buy a call option. See, the option Greeks, I think it will be a bit going overboard for the beginners, because these 2-part series, this is mostly for the beginners. The option Greeks we will discuss on our regular monthly tutorial. Are you there? Are you there in the monthly tutorial? You're going to attend it, right? Yeah. So we will we will cover the option Greeks on our. So for those who don't know, in option series, we have our regular monthly tutorials, which is the last Thursday of every month. As you can see, I like talking. So that also goes on long sessions, and there we address all the questions that our subscribers have, and also some of our subscribers, they put up their positions for analysis. So we literally do dissection and analysis of those positions, and that's how we kind of add value through the tutorials. Is that on 24th September? Is the Zoom invite already out, or do I have to register somewhere? Vaibhav, I think I will, let me check and get back to you, because Lance, who manages these Zoom invites, I think he had scheduled like multiple months that way. Anyway, we will post in the course group. So whatever is the last Thursday of the month. If it's 24th, yeah, it's 24th. So if it is not, we will again post it on the group.
Apart from Facebook, do you have any other source that we can follow? I'm not active on Facebook.
Yeah. So we have a YouTube channel. Actually,
yeah, I think I remember you sent me the links for the YouTube channel.
Yeah, the last couple of months we haven't been too active, but Fan Liang is focusing on that part. So soon we will have quite a few because I got busy with house moving, and a lot of things have happened. So we kind of that took a backseat, but very soon we will start doing that. No, it's basically restricted to Facebook and YouTube. That is how we manage our community. And of course, the Teachable platform itself, because all the course is all the videos, everything is hosted there. Both our investing fundamentals program as well as the option series program. They're hosted on Teachable. So
yeah, I think it's better I go through that first before.
Understand. So there are lots of preview videos. You can watch the preview. In fact, the links which Fan Liang pasted above, if you go to those links, you will see the entire curriculum for the silver, the gold, as well as the diamond section. And in the curriculum, many of those videos are preview videos. So you can actually click on them and you can watch the entire videos to kind of get an idea of cover.
Yep, I'll do that. Thank you.
That will give you a good idea. Are you on the investment forum group or our broader group, the open group?
No, to be honest, we have crossed paths a decade ago. That's how I know you, and I just subscribed. If you remember your Hyderabad days, I was there around you.
Oh, really?
Yeah, I'm Vinodan Shekhar's college buddy.
Oh, okay.
Skyla Apartments.
Of course, you should have told me earlier. You should have introduced me. Okay, good to see you here.
Yeah, nice meeting you. So that is how I followed you on LinkedIn, and I subscribed to your YouTube channel, but I got busy with moving jobs, changing jobs here in the US, and it fell through.
Okay. Good to have you here. It's
thank you.
Great pleasure. All right, guys. So since no more questions are coming in, should we call it a night, evening, afternoon, day, whatever it is, and let's take the remaining stuff in the part 2. Okay. Thanks a lot for attending, guys.
Thanks, Rupam. Thanks.
Yeah, thank you, Rupam. Yeah, we'll see you around.
Okay,
Thank you.
Fantastic. Great.
Bye-bye.
Bye, guys. Bye.
Thank you.
Take care.